education journalist. So we are honored to have you with us here today, and we take pride in welcoming you to conduct the Pulse Session 2021 on the BFSI sector.
So, okay, great. Thank you very much. And assume we're ready to start. Yep. Okay, good. So I'm going to share my screen. Hopefully this will work because I'm probably double all your ages. So not tech savvy. All right. Is this visible?
Yes, sir.
Yes. No. All good? Hang on. Let me just get this on full screen. Then just tell me if this is visible. Okay, can you guys see this? Say yes, no.
Yes, sir.
Okay, lovely, very good. Okay, good. All right, well, it's glad to see so many enthusiastic HR college students. I think we've almost have 300 people on board, and this is interesting because, from what I understand, because you're all HR college students, you are ambitious, but you probably have no idea what's happening in the job market mostly. And let me just start with a little question, right? And just let me just get you guys excited. Would any of you like to get a salary of rupees 1 crore per year before the age of 30? Yes? Yes, no, yes. All right, so let's talk about what does a 1 crore salary mean? The thing is that this is actually going to give you almost 10 lakhs a month, right? That means that you imagine if you actually earn 10 lakhs a month, what would you do that money? I'm like, some people don't earn 10 lakhs a year. Earning 10 lakhs a month is something that is amazing. Now, the thing is that very often you need to understand is that you keep on, sometimes those of you who read newspapers would probably see that people are getting 1 crore salaries, 2 crore salaries straight out of college. But unfortunately, those are people from the IITs, IIMs, all the top institutions. They talk about the multi-crore salaries on graduation. But realistically speaking, is that you guys are not techies. You're undergraduate BCom or BAF students or BMS students. So therefore, how can you look at getting a 1 crore salary, not immediately after graduation, but at least very quickly to really scale up and make sure that you make a lot of money and keep your parents happy, and you can spend a lot of money on all the things that you want to spend on, and keep your girlfriend / boyfriend happy. All right. So let's talk about some of the things. Now, when you talk about the BFSI sector, the banking, financial services and insurance sector, I know a lot of you are aware that post-placement, there are a lot of BFSI companies coming to HR college for recruitment. Now, obviously, then you think, okay, let me relax, let me just graduate. HR college will organize placement for me. There are a lot of companies who want to hire me. My life is brilliant, and I will make piles of money very quickly. Yes, the BFSI sector is very fast growing, but one thing we all need to realize is that all parts of the sector are not the same. Now, depending on the type of BFSI company you join, or the sort of category of BFSI company you join, you can make a lot of money or okay money. Now, let's talk about some of the areas. Now, of course, we do know in our organization, our talent services, we are working with almost around 35 plus large organizations in the BFSI sector across various categories. So we've actually understood the dynamics of the sector, what works, what doesn't work, and where you can really make a great career. Right? Let's talk about some of the areas. Now, the most basic part, I'm sure almost 100% of you will probably understand commercial banks, right? I mean, you're all familiar with the names like HDFC, ICICI, State Bank of India, Bank of Baroda, so on and so forth. But what exactly do banks do? How does a bank business work? It's quite simple. I mean, if you understand the basic way that all these BFSI companies make money, you'll understand the dynamics and how some of them grow faster, some of them don't. Now, when you look at banks, basically classic commercial banks, these are the things that you've probably been dealing with, your parents have been dealing with all their lives. Basically, they go to a bank, they deposit their money. Now, the bank will say, okay, you give me $100 and I will give you at the end of the year 106 rupees. You give you a 6% interest maybe on the deposit, let's say whatever the rate is. Now, how does a bank earn money by giving you 6% for all your deposits, right? That goes into lakhs and crores as you have many, many more depositors. What the same banks do is that they will take your same 100 rupees, they will not keep it with themselves, they will lend to companies. Now, companies say, hey, we want to grow, we want to start a new factory, we want to expand our sales and marketing. So we need to borrow money from a bank, and the bank said, look, I will give you this $100, but I will charge you 12 rupees for that 100 rupees. That means that at the end of the year, the company has to give the bank 112 rupees. The bank gives, out of that 112 rupees, the bank will give 6 rupees to you as a depositor and earn 6 rupees for their own operations and their salaries. Now, the great thing about the fact is that the 100 rupees has not gone anywhere. The bank still has 100 rupees. He's lending it to the company, but the company still has to pay back that 100 rupees. So very often the bank is actually giving you 6 rupees for your money, but earning 12 rupees from a loan. So therefore, that's how they make a lot of money. That's how they grow. And that's a classic basic model of all commercial banks everywhere in the world, right? From local HDFC, SBI, MNCs like Citibank, that is all they do. That's the starting point, right? But let's talk about something a little more interesting, right? Now, some of the newer parts of the lending space in India are what I call non-banking financial companies, right? Now, generally, when a commercial bank wants to lend to a company, they want to make sure that they get their money back, because obviously if they lend 100 rupees to a company and the company says, okay, I'll give you 12 rupees, 112 rupees back, but the company goes bankrupt, what does the bank do? The bank can't say, hey, I've lost my money, because then you as the depositor can't go to the bank and say, look, I've given you $100, I want to take my $100 back. The bank says, sorry, we lost all the money. That cannot work. I mean, and of course, some banks have done that, but that's been, the promoters have gone to jail. So what banks do, commercial banks, what they do is that they say, look, if I'm going to lend money to a company, I want to make sure there's something called collateral. That means that I know that even if the company goes bankrupt, I can take some of their assets to sell, so at least I can recover my money. So let's say if there's a typical promoter who says, look, I want to borrow, let's say 10 crores. The bank said, I want to make sure that the 10 crores comes back to me. So the promoter said, look, here's my house, it's worth 15 crores. I will put it as collateral. So if I do not give your 10 crores back with interest, you have the right to take over my house of 15 crores, sell it, and take your 10 crores back, and then the 5 crores remains will go back to the promoter. So the thing is, both banks say that if for every 100 rupees I lend you, you need to give me collateral of, let's say 15 rupees or 20 rupees, 200 rupees or 250 rupees. I mean, more collateral than the value of the loan. Now, that is fine for a lot of people, but the thing is that there are a large number of companies who don't have the collateral. So what if the owner of the company said, look, I want to take a 10 crore loan, but I don't have collateral more than 5 crores. What do I do? So that's when they go to non-banking finance companies, right? Now, non-banking finance companies are some of the companies who will lend to other companies which are slightly higher risk, who are not as conservative as commercial banks. So these non-banking financial companies are not allowed to take deposits from individuals. Like you cannot open a savings account or current account in an NBFC, right? Non-banking finance company. However, what these NBFCs do is that they borrow money from banks at, let's say, they'll borrow the money at, let's say, 9%. They will go to this other company and say, look, I will lend it to you at 18% because you are more high risk. Because your risk is higher, I want to charge more interest to cover that chance of you defaulting. And the NBFC says, look, I understand that you may not necessarily have as much collateral to cover the cost of the loan. However, I will look at your likelihood of covering the loan. Like, for example, let's say if you are a company which is making profits and there's cash flow coming in every year, and I know that the cash flow that you generate per year will cover the cost of my loan, then I know that you're like a safer bet. So even if you go bankrupt, at least I know you're getting some income, you're less likely to go bankrupt. But if you do go bankrupt, I have no collateral I can get from you. So therefore, my interest rate is higher when I lend to you, and that's how non-banking finance companies, NBFCs, generally lend to companies that are not covered by banks. And there's some names like Bajaj Finance, Shriram Transport, APAC Capital. They're not as well known as the banks like HDFC and ICICI and so on and so forth. But this is actually a faster growing sector in India than even commercial banks. Commercial banks are there, they're growing so low, but NBFCs are really, really scaling up. And I'm sure a lot of you have not even heard of most of their names. But it's a fascinating sector and a lot of potential there. Right? Let's talk about some other types of companies as well. Now, obviously, you guys all know the accounting firms. I mean, everybody's heard of KPMG, Deloitte, Ernst & Young, PwC. I'm sure a lot of you are thinking, especially those of you who are doing BAF and some of the accounting courses are looking to join one of the big four. But what exactly do the Big Four do? I mean, yeah, the names sound great, but what do they do? So basically, most of these accounting firms basically do audit work. I mean, that's a starting point. That means that at the end of a year for a company, they say, look, I have said that, let's say my company says, okay, I've in my accounts, I am declaring, let's say, 5 crore profit, and my debt is, let's say, 2 crore. Now, that's what I declare in my company, my own accountant. Now, the government says is that, okay, you are declaring a 5 crore profit, but therefore I will tax you on that 5 crore profit at a corporate rate of, let's say, 30%. Now, how does the government know that 5 crores is actually what you earned? What if you actually earn 10 crores, but you're just declaring 5 crores because you want to make sure that your, let's say, your tax is less? So that's where the government says we need a proper independent audit firm, like let's say the Big Four or some of the other audit firms, who will actually audit the accounts, check that the accounts are actually valid, that if you say you earn 5 crores, you actually have earned 5 crores and not hiding any income. And the audit firm will then certify to the tax department that, hey, I actually certified that this guy actually has earned 5 crores. And for that, the accounting firm will get a fee for auditing and because they're using their credibility. If KPMG says you actually have earned 5 crores, so therefore the government said, okay, I trust KPMG, so therefore I will accept that 5 crore statement from the company. So KPMG said, okay, I'll take a fee for certifying that by letting my good name. So that's the basic point. However, some of these firms are also going into other areas like advisory or consulting, and some of these firms saying, look, for audit, I can only earn certain amount of fees. I can't go beyond a certain value. However, I can actually advise companies on how to manage their financials better. I can advise them on how to invest in projects better, to actually grow their company better. And I will actually get more money from consulting and advisory than I may get from audit. So a lot of the companies are diversifying into the area of actually giving financial advisory to give companies ideas as to how to raise money, where to invest, how to grow, and manage their financials better. So that's really where, again, audit is what everyone knows. Advising consulting is, again, the exciting growing part of these Big Four and the other firms, right? So let's talk about the next one. All right, talk about insurance firms, right? So insurance companies, I mean, everyone's heard about Life Insurance Corporation, ICICI Prudential, Tata AIG. And the classic example of insurance firms is, hey, I'm the classic insurance salesman. I'm wearing like a tie and a shirt and going door to door and say, can you buy insurance? Can you buy insurance? And, a lot of people tend to look down on insurance firms and say, hey, I'll never be an insurance salesman. It's just that mindset. But let's understand how insurance firms work and why are they so important to the economy in the country, or like they say in most countries. In fact, it's safe to say is that the GDP of India, or let's say most economies, would not have grown so fast if it wasn't for the concept of insurance. Let me explain to you how that works, right? So some of you know is that how the insurance company works. So let's say, for example, you have your family, right? And you know that, okay, we're all healthy and things are fine. However, the possibility is that any one of you, God forbid, I mean, you could get involved in a car accident, you could land up with COVID, you could have, anything like any illness happening, or, God forbid, get a cancer, things like that. And you have no idea, you cannot guarantee that you will never fall sick, or any of your parents will fall sick, or anyone in the family falls sick. So, and once you get into a hospital, medical costs are horribly expensive. The thing is that if you get into a classic, private hospital, like let's say Akhil Shahani or Beach Candy or things like that, they will charge you lakhs every week. There'll be lakhs of your money going to pay these medical bills, and insurance and the hospitals will say that, look, you need to pay this much for medicine, this much for the surgery, this much for doctor's fees, this much for keeping your parent in the room, and it's going to cost. And you can't say, no, I will not pay these medical costs. And the hospital say, look, your family member's life is in the balance. If you don't pay, the guy may actually could die. So therefore, you cannot deny the hospital or the medical provider their money. But however, if you have all these lakhs, which could be of potential medical bills, how do you make sure that you can pay those bills, right? Now, without an insurance company, you would say, okay, look, let me make sure that I save at least 30 lakhs in my bank saving account. I won't touch it. And sometime in future, if God forbid one of my parents or somebody falls sick, I will have 30 lakhs available to pay for let's say, health insurance. However, the 30 lakhs that you've kept in the savings account, you can't touch. You cannot invest it in a new house. You cannot buy a car. You cannot invest it in a new business. It is stuck. It is useless. The insurance company says is that, okay, look, you don't have to keep 30 lakhs in a savings account. Every year, you pay me around, let's say, 20,000 rupees ongoing. And in the unlikely event that one of your family members falls sick, we will cover the cost of that 30 lakhs to the hospital. That means that instead of you keeping 30 lakhs in a bank account to save for health insurance, you are just paying 20,000 bucks a year to the insurance company with the idea that as and when, if it ever happens that someone falls sick, the insurance company will pay the medical bills, right? So now that works. Now, how does the insurance company make their money? Insurance company assumes that, okay, if they insure 1,000,000 people, right, and they're earning 20,000 bucks from 1,000,000 people, that's a huge amount of money to the insurance company to earn. But what they're also betting is that of the 1,000,000 people, the number of people actually fall sick or seriously sick will not be 1,000,000. It could be like, let's say 10,000 or let's say 5,000. So they will only have to pay out for those 5 or 10,000 people who have fallen sick. And also they may not have to pay out for the full 30 lakhs. So even though you may be insured for 30 lakhs, maybe the cost of your medical bill is only, let's say, 10 lakhs. So the insurance company is saying is that the number of people falling sick is less. The amount of money they cost for their medical bill is also less. So therefore, the insurance company is still earning 20,000 bucks every year from all these people, regardless of what happens to them. But from the viewpoint of the family, they feel safe that, okay, look, anything goes wrong, insurance company is going to give me the money. And the insurance company said, look, I'm betting that enough people will not fall sick, and therefore I will not have to spend all the money that I've accumulated. Now, why is this important for the GDP of the country, or let's say the GDP of all economies? Because, as I said, GDP is based as a function of how much you all are spending on goods, on like investing in houses, investing in cars, how much your, let's say, parents are investing in their business, how much they're growing their assets. Because insurance companies exist, you have your savings available to do this growth. You can buy cars, you can buy houses, you can invest in your business and grow the thing. The GDP grows because there's more money circulating in the economy. Without insurance companies, there'll be less money circulating in the economy, and that will actually, so it's actually, insurance companies are way more important than most people feel, right? And this is not just for health insurance, even life insurance, company insurance, fire insurance, so many liabilities are there. It frees up a lot of money to go in the economy, frees up a lot of your money to invest and grow, because you know that in any case, anything bad happens, you have somebody to pay on your behalf, right, for a small fee. So that's insurance. Stockbrokers. Now, again, we all know about guys like Rakesh Jhunjhunwala, who has earned billions of dollars just by investing in the stock market. We all know about Warren Buffett and all these great stockbrokers. And of course, some of the names you may be familiar with, like Angel Broking, Motilal Oswal, so on and so forth. But how do stockbrokers make their money, right? So the thing is that you as an investor say, look, I want to invest in the stock market, right? So therefore, you go to a broker and say, okay, obviously, I can't, as an individual, cannot buy a share directly. Like, I mean, who am I, right? So somebody has to open up a brokerage account for me. And I will tell the broker, okay, you need to buy, let's say, 100 shares of Reliance. Or let's say you need to buy 100 shares of HDFC Bank. And you buy those shares for me, and it will come into my demat account in my bank, dematerialized shares. Stockbroker will charge you a very, very small percentage for buying and selling. So every time you buy shares, the broker will charge a small fee to buy the shares. Every time you sell the shares to make a profit, the broker will take a share. So regardless, every time you buy and sell, you're paying a fee to the broker. But more importantly is that if, let's say, you bought Reliance for say 100 bucks, right? And you sold Reliance for 200 bucks, you made a 100 rupee profit. The profit goes to you. The broker does not get a share of the profit. Conversely, if you bought Reliance for 100 bucks and it went down to 50 bucks and you made a loss, the broker's not going to take the loss either. He's just going to take the fee anyway. So from the broker's point of view, he actually wants you to buy and sell a lot more, because every time you transact, he gets a fee. So that's how he makes his money. Now, what is interesting is that the last name I mentioned, Zerodha, a lot of people may not be aware of it, but Zerodha has now become the fastest growing brokerage firm in India. And all they do is that they're saying that, look, instead of you calling up your broker, an Angel Broking or Motilal Oswal or things like that, Zerodha says, okay, look, I will give you an app. You buy and sell on my app, and I will charge you 0% commissions. They make their money other ways, but the point is that for most Indian normal investors today, they rather go to a zero DAR to buy. I personally also use zero DAR more for my investment because A, they don't cost me anything. B, it's much easier to actually buy and sell on an app than call up my broker and buy and sell the old-fashioned way, right? So that is how stockbrokers make their money. So these are the guys who make or break markets. Some of these guys really are very influential. But let's be realistic. The thing is that if you really want to play in the stock market, you then need to make an effort to research which are the companies which are doing well. You need to watch CNBC every day. You need to, if you're really that great, you look at company balance sheets. Because see, the thing is that it's easy to just put a punt and say, okay, my uncle told me to buy the stock. But at the end of the day is that, unless you really understand the stock market, you really understand companies, or let's say how they operate and what their balance sheet looks like, are they a good risk or not? You don't want to just put in your money and gamble. You want to make sure that if you put in $100 in a company, you want to make sure it's more likely to grow and give you a $200 value instead of actually losing money. And the only way to do that is to understand the fundamentals of the company. So for example, like let's say if I'm investing in, let's say if I was investing in Apple stocks, right, in US. What's happening with the technology industry? Are people buying more smartphones or buying less smartphones? What has Apple's iPhone sales been like over the last few years? Are they growing? Are they coming down? Are there any new products that Apple's got? You have to really understand that and do the research. But most people have day jobs or don't really want to spend the time, because at the end of the day, it is a full-time thing. Some people say, look, I want to invest in the stock market. I want to get returns, but I don't have the time to study stocks. I actually have a regular job. I'm working in education or manufacturing or whatever. I don't have the time or bandwidth to do it. Therefore, what they say is, okay, look, I will now invest in a mutual fund. What's a mutual fund? A mutual fund says, okay, look, we realize that there's a whole concept of spreading risk. So for example, like let's say if you bought, let's say 30 stocks, right? Some stocks will go up, some stocks will go down, but on a net average is that your gains will not be, of the whole portfolio, your gains will not be that huge, but your losses won't be that bad. If you bought one stock, only one stock, and put all your money in one stock, that's like gambling, but you have no idea if you earn piles of money or lose all your money. If you're investing in 30 stocks, you won't make piles of money, but you won't lose piles of money either. So it's a good, safe bet. But the question again is, which are the 30 stocks you invest in? That's where mutual funds come in. So mutual funds say, look, we have full-time managers who are studying the stock market, who are studying investment companies. They are studying all the balance sheets, doing all the research, and we will create this mutual fund to invest in all the big cap companies, or let's say the large companies. Or we'll create a mutual fund to invest in the banking sector, or we'll create a mutual fund to invest in, let's say, mid-cap companies, smaller companies. In all cases, the fund manager who's actually managing the fund will analyze these companies, right, and figure out, okay, which are the best stocks to buy and hold in the fund. They will then go to you as an individual investor and say, look, instead of investing in the companies directly, come to us in the mutual fund and put your money in the mutual fund, and we will invest in these 30 stocks for you. The key thing is that if a stock goes up and down, the fund manager has the brains to know which stocks to buy and sell, so you don't have to bother. You just say, look, my money's in, let's say, Franklin Templeton Mutual Fund. My money's growing. I don't care what they do, how they manage the buying selling of stocks. All I know is at the end of the year, I'm getting a growth in my mutual fund, right? And the fund manager will charge us obviously a slightly higher fee than the stockbroker, but he's actually making a lot of time and effort to grow your money, and there's a certain cost to it, right? So mutual funds again are growing because in fact, majority of people in the world are investing in the stock market through mutual funds, not through the stock market or through brokers directly, mainly because they just don't have the time to study the stock market or study companies, balance sheets, and things like that. So mutual funds is basically a lower risk approach to investing in the stock market, right? So venture capital, this is where it gets really cool and glamorous, right? Because you may have heard of, I'm sure some of you guys have heard of companies like Byju's and Oyo and all these unicorns, and you say, hey, there's this, what's his name, Ritesh Agarwal at the age of 26, he runs Oyo and he's now a multi-billionaire, and, Baiju Ravindra. So everybody wants to be that, that super cool unicorn entrepreneur who's made piles of money, and people say, wow, your face is in the papers, and people ask for your gyan about how to live life and things like that. However, all these guys would never exist until they had a venture capital company, venture capital fund, putting and investing in these companies, right? So let's say you're Ritesh Agarwal, right? Want to start Oyo. And you say, look, hey, I'm a young guy. I've got an idea for a great hotel chain. You go to a bank, the bank says, ha ha ha, I'm not going to lend you because you're a young kid. I don't know who you are, and you may not necessarily have the collateral to like if I give you a 10 crore loan, you may not have a house worth 20 crores to put on collateral. So a bank will never talk to a young guy. The NBFC, Ritesh goes to the NBFC and says, look, I need a 10 crore loan. And the NBFC says, no, look, you're still a young guy. You don't have the asset. B, you also don't have a record. So therefore, I will not lend you the money either because you also don't have a record or cash flow or anything to make me believe that you will give my money back. So then what happens is that British goes to a venture capitalist. And venture capitalist says, okay, look, I like you. I like your idea. So what I will do is that I will not lend you money. What I will do is that you create this company called Oyo. And I, as a venture capitalist, will invest, let's say, 10 crores in your company to buy the shares of that company, right? The hope is that you, because you're a young guy and you think that you can do well, if I give you 10 crores for 10% of your company, when your company grows, the value of my shares will grow that much faster, right? So therefore, as a venture capitalist, I'm buying shares of your company. If your company goes bankrupt and the company closes down, I, the venture capitalist, will not get any money back. That means that my risk is total because I will never I can't go after the guy for his house. I can't go after anything else. The company, my value of the share is down to zero. It's like putting your money in a share in the stock market. As the company goes bankrupt, your share value is worth nothing, right? So, but the venture capitalist says, I'm willing to take the risk on this guy because in venture capital, the returns are that much higher. So, for example, the guys who invested in Oyo or Byju's right in the beginning, today, like for example, every $1 million they put in, I mean, now their $1 million is worth like, let's say, $100 million, 100x return. And again, what they're trying to do basically is that they have a higher risk model where they think the return could be that huge. However, the problem with venture capital also is that obviously everyone that invested may not give a 100x return. So they may invest in 10 companies. One may give them the 100x return. The other 9 may actually go bankrupt. So therefore, the venture capitalist says, I will deploy my $100 million fund, $10 million in 10 companies. One may give me, like, let's say, go up to $500 million and give me a great return. The other guys will go bankrupt and I lost my money. But the venture capital guy, how does he earn his money, right? Because obviously the venture capital guy may not necessarily have $100 million of his own money from his own pocket, right? It's not like he's a hugely successful individual. So what a venture capital fund does, they say, look, what we will do is that we will go to all these, various H&R, high net worth individuals, huge foundations, huge pension funds, and say, look, I'm creating a $100 million fund. You guys invest in this fund. Basically, you want to invest in the unlisted, the startup market. So therefore, you give me $10 million each or $20 million, and I will create a pool of capital, what's called a blind pool, from like, let's say, the Harvard Endowment, or let's say, from, Mukesh Ambani or whatever. And they all say, look, we're investing in the venture capital fund and we're giving you $100 million. The venture capital fund manager says, okay, look, for me to manage this $100 million, I will charge 2% fees every year. That means that I will earn $2 million from that $100 million every year to pay my salary, my office costs, my rent, my everything, while I manage the fund. However, my 2%, 2 million fees is nice, but not fantastic money. So what I will do as a venture capitalist, or what you call the general partner, I will take that $100 million and invest in 10 companies with the hope that they will all grow. However, what happens is that my real money as the venture capitalist says, okay, when I give the money back to my investors after exiting, see, because when I invest in the equity of these companies, I also have to sell these companies to somebody else to get an exit. That means a return. So let's say if I invest $100 million and compared to all the companies which have earned or not earned or exited or not, let's say I earn, let's say $200 million, right? So I will give the original $100 million back to my investors. Of the balance $100 million, I will take 20% of that profit. So I will earn $20 million. So understand, $100 million have been invested in me. I have invested $100 million. I earned $200 million. The first $100 million goes back to my investors. I will take 20% of the remaining $100 million. And so the investors earn $180 million. I earn $20 million. Not counting the 2% fees which I'm earning for the thing. So there are a lot of venture capital funds like Sequoia, Nexus, Matrix. I mean, there are n number of them floating in India because they all love the Indian economy and they think there's a huge amount of potential here. So these are the guys, the Sequoia and the Nexus are the guys who are invested in Byju's and Oyo and people like that. So there's a huge amount of potential in this space. In fact, these are the guys who earn piles of money. So when you're looking up these 1 crore type fees, 1 crore type salaries, these are the guys who get these salaries much faster than the others, right? So that's venture capital. The last one is investment banks. Now the thing is investment banks, they do a lot of interesting stuff. They're not the guys who will take money from a depositor. They will not lend out money. What they are the guys, they're the deal makers, right? So let's say, for example, Ritesh Agarwal wanted to raise money from a venture capital fund, right? Now, he does not know any venture capital funds. So what he does is that he said, I will actually get an investment banker who has a relationship with the venture capital funds, and I will ask this investment banker to raise money for me. The investment banker said, okay, let me look at Ritesh Agarwal. Does he look like a good company to raise money for? Are they likely to be successful or not? So the investment banker decides and said, okay, Ritesh, I will help raise money for you as for Oyo, and I will go to venture capital funds like Nexus, Sequoia, and so on and so forth. And for all the money that I raise for you, I will take 3 to 5% of the money raised. So therefore, if I raise $100 million for you, I will take $5 million as my fees. And that's all the investment banker does. Basically just creates a deal. Now that is raising money for companies. They do other things like IPOs. That means that, let's say, if you are a company and you want to go public in the stock market, you need to have an investment banker like a JM Financial or vendor who say, okay, we'll take your company public in the public market and we'll charge you for that. Right? Another thing, of course, which happens very often in the world is mergers and acquisitions. Very often one company buys out another company, companies merge together. So that happens all the time. And again, investment bankers are the guys in the middle making the deals. So the point is that regardless if they're raising money for startup companies, doing IPOs or doing merger and acquisition or anything else, they basically make their money through fees. But if you look at guys like, let's say, JM Financial, which is the largest Indian investment bank, vendors which are the fast growing one anyway, these guys are making millions and millions, hundreds of millions of dollars in fees because the deals are so large. So for example, when let's say Vijay Mallya had to sell Kingfisher to there's an investment bank doing that. Interesting. So even when Mukesh Ambani had to raise money from let's say Facebook and from Google and all to invest in Reliance Jio and other things, investment bankers were the guys who went out there to raise the money for him, and they made piles of money out. Trust me, this is stuff. And again, all this stuff is stuff that you generally don't get to hear in public. This is stuff that's all under the radar. Most the average public, I'm showing a lot of you guys, I've only heard of the BFSI industry from the names of, let's say, some commercial banks and some some insurance companies. That's it. All these other guys, highly likely that you may not have heard of, but a lot of these guys are making a lot more money and there are a lot more great career opportunities in these areas than just the classic commercial banks and things like that. So my point being is that when you're looking at building up a career in the BFSI space, don't just basically just take the first company that comes to you. Start looking and start investigating and say, look, I want to join a vendor or I want to join, let's say, Sequoia. Start figuring out how do I go about joining these companies to really get a good jump. But let's talk a bit about the trends in the BFSI space before I end, because what makes it so exciting today? Why is it growing so rapidly, especially in this country? Well, the first thing I think is very important is that today the BFSI sector is just getting totally digitized. I mean, today, until my parents used to go physically to a bank and actually put their deposit or put a check in, and some people still do. But today, most banking is now done on your smartphone, right? So you can actually transfer money, you can make payments, you can do everything. And in fact, people don't withdraw cash anymore. They all do payments through digital, right? So banks are now going on your mobile phone. Today, there are things like, let's say, Paytm, Amazon Pay, Google Pay, where you can make payments from your bank account to a vendor literally within 1 minute, without ever meeting the vendor face to face, without ever going to your bank and doing it. So again, digitization is happening. I spoke about Zerodha, which is the large brokerage firm, which you can buy and sell stocks on your mobile phone without talking to a broker and with very low fees. So digitization is pervading right across India. I mean, like, as you all know, the fastest the penetration of mobile phones in India is the fastest in the world. So it's not just all you Bombay-based smart kids who are very tech savvy. Even people in tier 2, tier 3 towns, people who probably themselves would not have got access to a mobile phone even, let's say, 10 years, 5 years ago, are now getting and using mobile phones for their work. So for example, as some of you may know, is that the Prime Minister had set up what you call zero balance Jan Dhan accounts for every citizen of India. That means that instead of you paying, let's say, your domestic help, or let's say your driver, or let's say your security guard in cash for their salaries, you just need to put a transfer of money from your account into their Jan Dhan bank account. Basically, they open up an account in a public sector bank, and all you have to do is transfer money to them, and they can manage it on their mobile phone. Imagine the hundreds of millions of security guards, farmers, domestic help drivers, all accessing online banking through their mobile phones. Widespread digitalization is actually fantastic, huge amount of opportunity for every financial institution out there in India. All right. The other thing which has happened is, as I mentioned, new forms of capital. The thing is that around, let's say, 20 years ago, if you really wanted to grow your company, the only way you could do it was actually going to commercial banks and getting a loan. Now, because banks would very rarely give a loan to most companies, and very few companies could actually raise money from banks, the number of companies in terms of growth was very little. I mean, the thing is that only a guy who owned a company who had enough collateral to get money from a commercial bank could get a loan to grow. But now what's happening is that because of NBFCs, venture capital, and other forms of angel investment and so on and so forth, companies where they don't have collateral, or a startup company, even a company that's making losses, can raise money and grow. That means that the number of companies which are being funded in India have exploded because of these new models out there. These models were not even there 10 years ago, but now because these new models have come up, companies are exploding, the economy is growing, and again, more and more money comes in. In fact, a lot of international investors are now putting in money in venture capital funds and NBFCs in India because they want to be part of the India story. I mean, we complain about the fact that India is growing at 5% year to year, down from, let's say, 7%. But other countries, I mean, like you look at Western Europe, they're growing at, let's say, 1% or 0.5%. So everybody wants to put their money into the BFSI sector here in India, which they can then lend out or, let's say, invest in equity in this economy. So this is, again, totally exploded. Then, of course, a third thing is actually a mindset for all of us. And like, I'm sure some of you remember your grandparents said, "Arey, beta, do not spend more than you earn. Therefore, if you want to buy a new car, you basically first save all the money, keep it there, then buy a car, never take a loan. You'll never sleep at night if you're taking a loan." Now, that is fine. But the thing is that means the number of people buying new cars, or let's say buying a flat screen TV, or buying, let's say, a fridge, was less, because they only from their savings and that mindset of saying that I will spend only for my savings and all the money up front would people buy. Now, what's happened now, which has actually now happened globally and is now coming to India more frequently, is the model of taking and paying on EMIs. That means that today, when you go to, let's say, go to Amazon or let's say go to Crore and say, I want to buy a large flat screen TV, you may not necessarily have all the cash in hand. So you say, look, I will buy it, but I will pay EMIs. I mean, like instead of me paying, let's say, $50,000 to buy this TV, I will actually spread the payment across a year and just pay, a few $1,000 every month, because I can afford that on my salary. So I get the TV, I can use the TV, I take it home and use it, and I will pay over the year. Versus me waiting and saving from my salary for the whole year, and at the end when I accumulate $50,000, I will buy the TV. So what's happened is that people are saying, look, I would rather buy the TV or the car or the house now and pay over a period of time. I mean, house mortgages today, I mean, how many people have 5 crore or 10 crore to burn on a house? However, with a mortgage, you go to a bank and say, look, I will actually borrow, let's say 8 crores from you. However, and I will pay you a mortgage. That means that you lend me 8 crores and I'm paying you every month some money back plus interest. If I don't pay you back, you have the right to take over my house. So this is interesting, right? Because you may not own a house, you have no assets, but the minute you actually buy a house on a mortgage, you now have money to buy the house, and secondly, you have the asset to give a collateral to the bank to take over in case you think. So worst comes to worst, if you are not able to pay the bank, basically the bank will take over your house and you're back to square one. No money and no house. But in any case, if you have no money, no house, anyway, in the beginning, with the mortgage, you have money you have a house and you also have a bank mortgage to pay. So the risk is actually much less to you. So therefore, the model of consumer financing through EMIs, mortgages, and things like that have now become more prevalent. So therefore, people are buying more. I mean, the number of TVs, cars, mobile phones are all now coming on EMI. A lot more people are buying more stuff. The economy is growing drastically, right? So, and of course, a couple more things is that insurance industry now. Insurance at one time was just basically okay. If your parent passes away, we will pay life insurance. That means that we will give you some money to compensate for your parent dying, or let's say health insurance. But now a lot of options of insurance are there. So let's say, for example, there's a concept called liability insurance. So, for example, I run colleges, right? So let's say if somebody in my college, let's say, slips and falls, right? I could actually, they could sue me and say, hey, you had a very dangerous environment in the college. I slipped and fall, so you have to pay me compensation, not just for medical fees, but even for mental anguish and things like that. I take what's called liability insurance. That means that I go to insurance company and say that I have no idea what's going to happen in my college, but in case I ever get sued for something, at least I know that you guys will pay. So the idea is that my money is freed up because of that, right? So the thing is that companies have liability insurance, they have insurance for fire, any untoward event. You also have insurance like what's called hedging. That means that let's say if you want to, trade with an international, let's say you're selling, let's say you are borrowing money in dollars from a foreign entity and you have to pay back and you're earning in rupees. If the rupee rate drops drastically and you have to spend more rupees to get back to dollar, you actually have a situation where you actually lose out a lot of money because you're earning in rupees. You have to earn that many more rupees to pay back the same dollar loan, right? So there are ways to insure against that. That's called currency hedging. So my point being, insurance is basically a way to give you a sense of safety. And again, all these models have really scaled up in India. So there's huge potential in the insurance industry there. And of course, because of the huge explosion of the BFSI sector, the BFSI sector tends to be the first adopter of technology. So for example, let's say I'm an insurance company, right? And I need to analyze out of, let's say 1,000 people who are applying for health insurance for me, how do I know what insurance premium to charge? So supposing there's a 60-year-old guy who's got a heart problem, who's asking me to insure him for, let's say, 1 crore, versus a 25-year-old guy who's asking me to insure for 1 crore. I won't charge the 25-year-old guy 20,000 rupees a year and the same rate to the 60-year-old guy, because it's more likely that I will have to pay a payout to the 60-year-old guy, his health insurance, versus the 25-year-old guy. So therefore, I using data analytics and AI, I need to analyze and say like, okay, I will charge the 25-year-old guy 20,000 rupees a year for premium, but the 60-year-old guy, based on my data analytics, says that, okay, I need to charge the guy at least 50,000 rupees a year to cover the likelihood of him more likely taking insurance money from me. So therefore, data analytics has become huge it's called underwriting, right? So you have to analyze and say, what's the likelihood of me earning money out of insuring, let's say, 1 lakh people. Artificial intelligence is now, before data analytics was done by human beings, now AI, artificial intelligence is now doing a lot more analytics and making it more streamlined, more granular. Cybersecurity again is very huge because you must be hearing about, this bank scam happened and somebody drained out this person's account by just setting an OTP, I think like that. So cybersecurity basically are these firms that actually make sure that there are no hackers and other people coming into and stealing your money from a bank, right? So cybersecurity is huge because the thing is that banks still have to owe you money if you deposit. And so if a hacker comes in and starts cleaning out your accounts, the bank still has to pay you money. The bank can't say, sorry, hacker cleaned your account, you have no money. So cybersecurity firms will make sure that there are a lot of, let's say, software guards that make sure that hackers can't come in. And it's a constant war because hackers come up with new methods of breaking in. The cybersecurity firms have to come up with new methods of saving the banks and other firms. So again, because the BFSI industry is growing so rapidly, there are a lot of firms providing AI, data analytics, and cybersecurity and other technical services to these BFSI companies. And that itself has become a huge industry. So very often the IT industry is growing anyway. The BFSI industry is growing so fast, it is helping the IT industry to grow, and the IT industry capability is allowing the BFSI industry to grow. So it's like helping each other that way. So it's a good partnership per se. Okay, so just a little end before I get to the thing. So basically, I run Ask Talent Services. I mean, of course, I run colleges and other things as well, but Astan Services is our dedicated placement firm that does a lot of placement for students in various jobs, right? And so we've tied up with around 25 plus BFSI companies, and even during COVID, and this is where it's interesting because we really understand these companies what they want. Surprisingly, even though people say that there are no jobs opening in during COVID and it's kind of dead phase, we've placed around 900 plus students during COVID over the last few months through online interviewing, online placement, and because we understand where the jobs are, who's there, and we actually get first crack at those jobs because we have a good method of doing this. Today we have around 2,500 open jobs available. We've got guys like Deloitte, guys like Nexus, guys like all these large brokerage firms, all these large insurance companies, banks, BFSI institutions, all saying, okay, look, we now have all these open jobs available. Can you help us with students? So one of the key things that we're doing is that we're helping out with HR College and with all the other colleges in the group like KC and National and so on and so forth, and saying we have what's called an employability test where we'll assess your ability to be employed. And if you pass that test, then we are happy to send your resume to these BFSI companies and you actually get a better job than this classic placement model, right? So I'll end here and I'm happy to take questions at this point. Yep, questions, anyone has? Or you all know stuff and your minds are totally blown. Okay, so if there are no questions, hang on a second. Okay, good. So they've got, okay, there's a Anmol Rohira who actually asked me a very intelligent question. Is it safe doing trading on zero DA? All right, good. So let me explain to you. Now, the thing is that when you are, zero DA is a broker, right? They don't own your stocks, right? So what happens is that basically you have created what's called a demat account in your bank, and you say, look, I will want to buy and sell stocks through zero DA. So that means that if you buy, let's say, Reliance through zero DA, and the Reliance share is in your name. If zero DA goes bankrupt tomorrow, Reliance share is still in your name because the Reliance share is in your demat account. All zero DA has done is bought and sold on your behalf, but they don't own the share. So zero DA is as safe or as unsafe as any brokerage, Motilal Oswal, things like that. But what's happened is that because their costs are so low, they've made a point to see that they actually, people say, okay, let's rather go to zero DA because it's much easier to buy and sell. Zero DA not just buy and sell stocks, they also do investing in mutual funds, they do investment in things like gold, other exotic index funds and things like that, which are more complex. But in all cases, all they're doing is facilitating the buying and selling. The ownership of the stock, the ownership of the mutual fund, the ownership of everything is all in your name. So even if they go bankrupt, you still have it. So zero DA is very safe from that point of view. Okay. Someone was saying Jai Maharashtra, so I think that's good. I'm glad you're patriotic. Anyone else? Yeah, okay, some guys, Sumit Singh's raised hand. Okay, so Sumit, could you either type your question or just ask it, unmute yourself. Are we allowed to unmute people? As who's organizing this? The HR college organizers, are you unmuting people to ask?
Sir, can you hear me?
I can hear you, yes.
Yeah, so I was just wondering, what would be a good way to look into the consultancy sector, financial consultancy in particular?
Okay.
I apologize for the bad connection.
That's no problem. Hopefully my answer will be clear.
I'm looking for a way to break into it or to get some experience because that's an area I find myself very interested in.
Okay, good. So let me ask you a question. What does consultancy mean to you? When you say break, what does it mean?
From what I know, there's different kinds of consultancy. The particular one I'm interested in is strategic consultancy.
Okay, good. Which other companies in the strategic consultancy space?
So obviously you've got the big three in consultancy, BCG, Bain, and McKinsey.
Correct.
But they are pretty fast growing in India.
Right.
But I don't know, like, how would I reach out and how would I break into the sector or prove to them that, hey, I've got the chops to at least, become an associate in that area.
Good. All right. So good. So let me answer your question by giving you advice that actually will work for anyone joining any company in any sector, right? See, remember one thing is that what is less known is that the best jobs out there happen based on who you know, not what you know. Right? So, for example, don't forget is that if you let's say you want to go after McKinsey, for example, or let's say BCG, if you just send your resume blindly to them, trust me, there are like hundreds of people sending resume. So there's nothing that you will have that, okay, I'm an HR culture, big deal, who cares? So there's nothing you can show. So therefore, what you have to say, how do I make sure that when they are looking for an associate, my resume or my profile is higher than the others, right? So what you do is that the first thing to do is to, and this is where sites like LinkedIn and all are very important. Stop wasting your time on Instagram and Facebook. All of you, please go on LinkedIn. You guys are now old enough to stop being kids, right? Because you're now concerned about your jobs. So you need to find people who are connected to McKinsey on LinkedIn or connected to BCG. That's a starting point, right? The second thing is that you approach them. And the thing and one thing is very great is that you say, sir, I want to build a career in the strategic consulting industry. Can I get your advice? People love to give advice. I mean, like, I'm spending, 2 hours of my time just giving you guys advice. I mean, people love to do that, right? So the thing is, so all you say, you don't say that, okay, look, sir, I want to join your company. You say, sir, I want advice. Or ma'am, I want advice. And you say, okay, can we have a call or preferably post-COVID, have a coffee with them because sometimes that, that personal bond is important. Once they give you advice or give you support, then in a way, they get a little more locked into your success because they want to feel that, hey, okay, beta, I'm giving you advice and you ask the right questions, you look intelligent. Okay. Oh, by the way, there's an associate opening. Maybe I can send your name there. So that is come to a strong reference, right? Now, LinkedIn, of course, is more like a very widespread thing. I mean, like you will ask maybe 20 people for advice. Maybe one person may respond. However, don't forget all about who you know. Don't forget, in your own friend circle, you may have uncles and aunties who are working in McKinsey. Right? So, who among your friends have fathers or mothers working in BCG or Bain? Ask them for advice. Who among your family, your uncles and aunties themselves, I mean, these are people you ignore otherwise, but if anybody you know is working in BCG, McKinsey, then you ask them. So at the end of the day, it's really get access to somebody who's either working or know somebody in those firms and get advice. The more advice you get, the more you find a way to sort of target your resume and get a better chance.
So it would be like gathering information about what they're looking for and understanding if they have any openings within their industry.
Right, and it's also selling yourself. The thing is that, so if you have an opening, why should they hire you? Well, so the more they get to know you, the better, no? So, but again, the thing is, you just don't go blindly and say, okay, look, let me learn about McKinsey. All you guys have Google, right? The thing is that go on the McKinsey website, read about them, see what projects they're doing. They have all these consulting firms like to keep on publishing reports and research reports and white papers. So read some of the reports. When you ask questions to these people, ask intelligent questions. You can't appear dumb. Remember one thing is that if you want to get a great company that you aspire for, you cannot appear dumb. I mean, okay, your parents may love you, your uncle may love you, but nobody else loves you, right? So make sure you research on the company you target. Make sure you understand what they're looking for. Make sure you find someone who's got a connection to the company and then take that path. Because you don't want to be that person just sending a blind resume.
Yes.
Right? So that works with all companies, not just.
Thank you, sir.
Let's see. What else we got? Between mutual funds and fixed deposits, which is a better investment? Okay, good. I will give you advice in the BFSI sector. I will not tell you which investments to put your money in, but let me just talk about a general thing. This is very basic understanding of finance, right? The concept of risk versus reward. Now, when you put your money in a fixed deposit in a bank, right? Every 100 rupees you put in a fixed deposit in a bank, you know for a fact that it's 99.9% likely that you will get 6 rupees at the end of the year. That will always happen. So your 100 rupees will become 106 rupees, next year will come 112 rupees, so normal compounding. That's fine. However, you say, look, I can't live on 6 rupees here. I mean, the thing is that at the end of the day, you have to spend the money somewhere, you have to do something with it. So then you say, look, I would invest in a mutual fund. Now, mutual fund says is that, look, I will invest in the stock market for you, and I will give you a return of, let's say, 12 rupees. So your 100 rupees could potentially go up to 12 rupees or 40 rupees. However, it's also likely that your money may also go down less. So your 100 rupees may go down to 95 rupees. So what the mutual funds say is that we can't control how the stock market is going to grow year to year. However, we know that if you put your money with us for 5 years, on an average, you do better than in fixed deposits. So which is why they talk about look at the mutual funds past performance, see what's happening in the market. You know the Sensex is going up anyway. But the thing is that if you say that suppose the stock market crashes for whatever reason, you can't go to mutual fund and say, okay, give me my money back. They say, look, the money is gone or gone down. But higher risk gives you higher return. So it really depends on what your appetite for risk is. I think what I always suggest for most investors is that always invest money that you don't need immediately for the next couple of years. So then you can play with that, and whatever you earn, you can earn. But let's say worst comes worst, your investment goes down, at least you're not bankrupt. So understand your money you need for a living, and anything that you have extra, just invest. And I also believe that the concept called SIP. SIP means that every month, put in, let's say, 5,000 rupees. If you get pocket money, if you earn money, invest, let's say, 10,000 rupees every month in a mutual fund. Because no matter the market goes up and down, every month you're investing something in mutual fund, it'll average out over a period of time. So you don't have to depend on the market to go up or down. You just keep investing. You will actually do much better than putting money in an FD. So yeah, but use your own brain. I mean, okay, all of you start using your brains. Don't just blindly take people's advice. I'm giving you advice. Research. Today, there's a lot of information out there on websites. Ask these questions on Google. Between mutual fund and FD, which is better? There are a lot of people, a lot of ideas there. So use your brain. Okay, crowdfunding, good. So yeah, good question. So crowdfunding basically is a model, just for rest of you, is that a site, okay, let's say for example, there's a site called Keto, right? Keto says is that, okay, look, I have people who want to, let's say, or let's say there's another one called GoFundMe. So GoFundMe says is that, look, I am a small company. I want to set a new product. I will borrow money from individuals, right? So like, I don't want to borrow money from venture capitalists or let's say banks or let's say NBFCs. I have this new product idea and I want to raise, let's say 1 lakh. And most crowdfunding is small amounts of money. So you get onto the crowdfunding site as an investor and say, look, I don't mind spending 10,000 bucks on this guy because this guy has promised me a run of 20,000 rupees, right? So my 10,000 rupees comes in after a year and a half, I may get 20,000 rupees. Now, again, it's high risk, high return because with crowdfunding, if the guy doesn't give your money back, you can't chase him for your money, right? I mean, the thing is so, but if he does give your money back, you get a much higher return. So therefore, what happens, most crowdfunding is great for very, very small investments, where you say, look, I don't mind putting 10,000 bucks or 20,000 bucks because it won't kill me. If I get a great return, great. If I don't, no problem, fine. But the problem again with crowdfunding is that if somebody posts on, let's say the crowdfunding site that, look, I want to raise 1 lakh for this product idea, you have no idea who that person is, right? So therefore, your trust in that person is also less. Unlike an NBFC or a bank, which will do a lot of research on the company before they decide to lend money, you have no time to do research. So therefore, typically it happens for small fundraise or small, let's say, small investment. It's a great source to be, but it's growing, but not as, it doesn't grow as fast as the other sectors, mainly because the trust factor is a problem there, right? Okay, so, okay, good. So Bajaj Finserv provides loans to customers on Flipkart and Amazon EMI based for 6 to 12 months without interest. How do they earn money? Okay, good. So look at this way, right? Supposing I have a flat screen TV. Let's say I'm Samsung and I want to sell that flat screen TV for 20,000 rupees, right? Now, when I am selling the flat screen TV as Samsung, my profit is, let's say, 5,000 rupees. Let's say my cost of manufacturing is 15,000. I'm selling it for 20,000. That means I earn 5,000 bucks profit. Now, for somebody who can afford to pay 20,000 bucks, great. I've sold it. I've earned 5,000 bucks profit. Great. However, there are a lot of people who can't afford that 20,000 rupees and they want to do an EMI thing. Now, for me, I can say either I will sell it, I will give you an EMI, but I will charge you interest. So let's say I as Samsung will charge you interest and say that, look, I will sell it for 20,000 rupees, but I will charge you, let's say, 10% interest. So therefore, by the end of the year, you paid me 22,000 rupees, right? So that is fine. So therefore, I've earned 5,000 rupees plus 2,000 rupees interest, but it's like a loan. Now, a lot of customers say, no, I don't want to pay the interest. Then I won't buy the TV. So then I will go to Bajaj Finserv, and Bajaj Finserv says, okay, look, I will lend to the customer, and you take a hit on the interest. That means that instead of me as Samsung selling the TV for 20,000 bucks, I will sell it for 18,000 bucks. 2,000 bucks goes to Bajaj FinServ to give the loan. So you as a customer feel happy. Hey, I'm not paying interest. I'm getting a TV at no interest, and you feel happy. But the thing is, you're more likely to buy the TV because you feel happy I'm not paying interest. Me as Samsung is saying, look, at least a TV where I get a 3,000 profit is better than not selling the TV at all. So it's like, it's like when you go to a hotel, right? So hotel prices keep on changing depending on demand supply. So what these guys are doing basically saying, okay, we won't charge you interest to make you more likely to buy, but in a way there's a hidden cost that me as a company, Samsung, is paying to Bajaj FinServ. So that's how it works basically. So what's happening is that as people are getting more and more spoiled and want to get EMIs without interest, now companies are more forced to provide these interest-free loans to people, but you're buying more stuff. All right. There's someone who has taken up marketing but wants to shift to finance. How should he claim himself qualified for finance? Well, it depends on what sort of job you want. So let's say, for example, if you say, I want to get into the financial sector, and see, the finance sector also has many jobs, right? So if you say, okay, I want to get into analysis or back-end support, or like I'm actually doing underwriting, understanding risk return, analysis of financial software, understanding audit, and things like that, obviously you may have a problem. However, the fastest growing space in the BFSI sector is the business development part, right? That means, for example, if you are going to do deals for venture capital as an investment banker, you need somebody to go out there and meet the venture capitalists and raise the money, right? That's business development. If you are doing, let's say, setting up insurance or even loans for companies, in fact, even NBFCs sometimes need a business development guy to connect to companies and say, hey, you guys want a loan? So that is growing a lot more. Most of the companies today are hiring business development. So you frankly can have a background in marketing, human resources, to be a BA if you want. If you are good at business development, you will actually get a job in the BFSI sector. So I'm assuming that a lot of the BFSI companies that come in to HR college, a lot of them are hiring for business development roles or where there's a sales role. So that's, I mean, qualification is really based on your ability to work hard and convince people to do stuff. All right. Why do employers in the consultancy finance sector prefer candidates from the engineering background? Okay, interesting. So I'm actually my engineer myself. So my background is I did my electronic engineering in Thadomal Shahani Engineering, then MBA at Kellogg, and now PhD in University of Liverpool. Why do they want engineers? There are two things, frankly. The thing is that when they are hiring people at the entry level, right? Remember one thing is that they may be hiring for, let's say, 50 jobs, and there may be 1,000 applicants for those 50 jobs. Now, how they determine that, let's say, candidate A is better than candidate B, because A, they look at your resume, and nowadays everybody has the same looking resume. I mean, everybody knows how to structure a resume. Everybody knows what are the 20 most important interview questions to answer. So there's no way to filter out. So therefore, and the company may not have the energy to interview all 1,000 candidates. They say besides the resume and the fact that the kid looks good, I believe as a company that a kid who's gone through engineering would have better math skills and be logical and may have worked harder to get into the engineering college than the kid who's gone for BCom or BMS, right? So for example, if a kid has gone into IIT, for example, I know for a fact the guy has worked extremely hard to get the JEE exam. He's probably wasted 3 years of his life or 4 years of his life. He has done very well in maths and logic. And he's shown that he is the top 1% of the employment pool. So therefore, someone from IIT, I will hire regardless of knowing how good or bad he is, because of IIT charm or engineering charm. Even though I may never use him as from the engineering aspect or the technical aspect, I know his math and logical skills are higher. Secondly, he's worked harder than the average BCom kid, right? So the thing is that it's a risk reward. Now the thing is that, so if you are saying that if you are not from an engineering background, what can you show to the company to show that you are better than the engineer? And that's where things like coming like, okay, how many internships have you done in college? What work have you done in college? Have you worked? Have you done work with? Have you worked in college festivals? Have you taken leadership positions in student bodies? Have you done any CSR NGO work? What's your personality like? Are you well read? Are you able to understand when you go to the company for an interview? Do you actually even know the company? Have you actually checked their website, seen what they're doing? So because you are starting with that, how should I say that? Not handicap, but let's say you're going, you're less than the engineer from the viewpoint of logic and the perception. You have to do other stuff that makes them want to hire you, basically. So, but it's really up to you. It's not that. But that being said, on a general thing, an average BCom student, average engineer, regardless of the job role, engineers will get it. That's like, deal with it. What are the job profiles which are available in the BFSI sector? Payal, there are around 4,000 jobs available in the BFSI sector. I'm not going to tell you what they all are. What you can do is actually check on any website and you find the job profiles, right? So that's easy. Is technical analysis better for studying any stock or fundamental analysis? Good. So let me ask Pratham. Pratham, if you're there, let me understand what is in your mind, what is technical analysis and what is fundamental analysis? Pratham, tell me, what's the question mean? Pratham? Okay, well, Pratham, decide I'm going to the next question.
Can I just fill in for this question?
Yeah, both.
Yeah, so fundamental analysis, by my understanding, basically means how is the company's balance sheet looking, the cash flows, the P&L account, what are the future plans of the company.
Right.
And technical analysis is mostly based on the charts and how the company has been doing in the stock markets of lately.
Okay, fine. So let me ask a question. Why would you do only one and not the other? Like when you're investing in a stock, you're not going to say, I will only look at the balance sheet and not how they perform. Conversely, I will only look at how they perform, not their balance sheet. But let me also say the third thing, right? I mean, this is something that you need to understand when you're investing in the stock market. Tell me something is that, okay, if you know the stock market. So let's say, what's the price of Reliance shares today, roughly? Reliance Industries.
So it's around
1950.
1950, right? What was it last week, roughly?
Around 8. It was range bound between 1880 to it went to 2060 also in the recent past, but before that it was around 2300 or so.
Good, fine, good. So now Reliance in 1 week has gone from, let's say, 2060 to 1950. What happened to Reliance? Did their balance sheet suddenly change last week? Did their fundamentals change last week? Did their stock performance over the last 5-10 years change last week? What happened in that 1 week?
So the market sentiment changed because of the court cases. It's kind of competition with future retail and its acquisition with future retail and its problems in the tribunal.
Absolutely right. So the thing is that technical analysis and fundamental analysis is your baseline. You have to understand market sentiment. You have to understand what's happening in the environment. So for example, so Reliance is a well-known stock. What are you going to do about these mid-price stocks where there's actually less research? But the idea is that if you're doing any analysis in the stock market, you have to make sure that you give your life to it. In the sense that you constantly looking at balance sheet, looking at the candlestick trend analysis, understanding market sentiment. Oh, okay. Oh, by the way, stop looking at CNBC that way because there are a lot of experts who give their own yarn. And when their yarn turns out to be wrong, they never turn back and say, hey, sorry, I made a mistake. So everyone will always give an explanation after the fact. So there will always be things about the market sentiment that you will never know in advance. That's a bet you're making. After the stock has changed their price, you say, because the market sentiment has happened. So for example, if Reliance stock has gone down from 2060 to 1950, you're thinking maybe market sentiment because of the court case. You don't know that. You have no idea what the market's saying because this is an explanation after the fact, not before. So that's the thing. So the idea is that there's a lot of variation. So as I said, so either you spend all your time studying the stock market for sentiment and technical and fundamental, or you say, let me just give my money to a mutual fund manager who's doing the work himself, right? So it's not one or the other. Okay, so how to stand up with profile for graduation? I've answered that question already in terms of what you've done, in terms of, let's say, internships you've done. How to get into the BFSI sector? I've already, the last 1 of ours has basically been talking about that. Have you come across the word actuaries? Do you have any knowledge around the role of actuary? Okay, so my friend Aditya, have I come across the word actuary? You type in the word actuary in Google and type the word defined actuary in Google, you will get all details, all the yarn you want about actuary. Okay, see, one thing I need you guys to understand, and this is something, okay, I'm here, okay, we're spending time, having a good time talking. Use your brains, yeah. You want to know about something, go on Google. Don't ask questions. What do you mean by actuary? How to get a BFSI sector? I mean, those are basic questions, yeah. You guys are all HR students, you're much smarter than these questions here. So again, there's no such thing as a stupid question, but sometimes make the effort to research because you will find a lot of information and you'll actually get a lot of yarn out of it here. But okay, Aditya, I've heard of the word actuary, but I don't. Google have more knowledge about it. Okay. Yeah, same thing. So someone who wants
So,
to
so,
into, Bolo.
so
Okay.
I'm so sorry to interrupt you, but actually we are running short on time. So
Okay.
I guess that was the last question we could take. But on behalf of the placement cell, I would really like to thank you for conducting this insightful and engaging session with the students. It was
Okay.
really informative and helpful. I would
Okay.
also like to extend a vote of thanks to our principal, Dr. Pooja Ramchandani, and our director, Dr. Naveen Punjabi, for all the support and guidance. Thank you everyone for joining in. Please make sure to fill the feedback form, which will be sent to you. Thank you so much.
Great. I'm glad. Okay, so just for further more questions, and I'm just as I mentioned, so we've got a link of this employability app that Neha has put. I think seriously do the employability test because it will give you a lot of understanding yourself as to how good or bad you are with regards to the sort of job that you want. So if you say I want to join the BFSI sector, I want to join consultancy, I want to join this will actually give you an analysis of what your capabilities are vis-a-vis those jobs. So do take the employability test. The link has been put in by Neha, and I'm sure they'll also distribute the link. And also, if you guys really want more serious information, we do have a bunch of these career advisors in ATS who can give you specific advice on various areas of the BFSI sector. But I wish you guys all the best. I'm sure that you all do very well. Your HR students, you have to. And bottom line, two things: just make sure you differentiate yourself, build up your network, and research. Research, just research. That's it. All right. Thank you all very much. Thank you. Bye-bye.